Hey guys, Christopher Aaron here. Thank you for joining me. I want to thank those people who wrote in over the last several weeks to ask where I was. I have been here caring for a loved one who was sick over the last few weeks. So when times like this happen in life, it's important that we make priorities. My priorities were to be with my loved one and to step away from the markets for a number of weeks. So thank you for your understanding about that, and I wanted to let you guys know that we are back on track. So, join us. We will get to the charts in just a moment. Where's Klaus? Where's Klaus? There he is. Good boy. Come on, shall we go? Let's keep going. Let's keep going. Hey Klaus, come say hi to everyone. Come on, come say hi. Hey, over here. Good boy. Hi, buddy. What do you see out there, huh? I know, it's super wild. Come on, let's go. Very good. So guys, we're up here. We're going to talk about some pretty serious things here in this video. The major trend break that we're seeing in the US dollar, multi-decade trend break. What is the pattern that's shaping up for the dollar? There's a lot of people out there that are the permanent doom and gloomers for the dollar. You know, the dollar is going to zero. It's going to become confetti paper money. I am not quite in that crowd. However, we do have a very reliable pattern that we are seeing in the dollar that shows us that it is going to lose a significant portion of value. Not immediately, not even over the next 1 or 2 years. We're really talking into the later part of this decade and more likely in the 2030s. But it's still going to be close enough that it impacts most of us who are alive and participating in the markets right now. So you'll want to pay attention to this coming up. This is going to be a special broadcast, a special snippet of our premium service for you. I've been away so long. We're going to do quite an in-depth segment here on the US dollar and what we are actually seeing on the charts. Big item that we are going to talk about today is the US dollar. US dollar breaking down officially from a decade-long rising channel shown here in magenta. We have been looking at this every couple of weeks here, especially for the last several months. We've been talking about this and talking about it, and I think there were a lot of people saying, I don't believe you. I don't think this is going to really start to decline here. It looks like support might hold. And sure enough, over just the last 2 weeks, we have finally seen the dollar crack through the lower boundary, this dashed magenta line, the lower boundary of that decade-long rising channel that we've been studying here. And this is, I'm just going to say it up front, what we're seeing now in the year 2020 is the prelude in our work, the prelude to the US dollar losing its status as the reserve currency of the world. These technical gyrations that you are seeing right here, and especially this breakdown, is the prelude to the dollar losing its reserve currency status. This will impact each and every one of us. I do not think the dollar is going to lose its reserve currency status anytime soon, perhaps not even this decade. But we will get to some projections for this, and we're looking very closely right now at the dollar as it's making this break here below the lower boundary of this trend channel, at the dollar falling below its all-time lows, which are shown here from 2008, sometime in the middle part of this decade. And then that would be the real warning siren that the reserve currency status of the dollar, when this all-time low breaks, that reserve currency status is soon to be given up. It's not going to take too much longer after we get down here for that actually to happen in the geopolitical realm. So we're looking at the prelude to this now. About 3 months ago, we saw the break here of the solid magenta support level. Sometimes we show two support levels when we have a bit of a broadening out here. We will show the solid line as the best fit line, the best fit, including this low right here. So that's solid. But then we show the dashed line to represent the absolute lows. If you notice this little flash right there, this little black line gives us the absolute lows trend line, which, notice, it was not random that the dollar started bouncing in here at that absolute lows trend going all the way back from 2014. So there was the first break. Here was this little dance that we've been in for the last 3 or 4 months, and boom, just 2 weeks ago, we see the legitimate breakdown in the US dollar index. What now? Okay, so let me show you how I think this is going to play out, given that we've just seen this trend break. The dollar closing at 90.8 for the week. We needed to see the close below 92. We got that. Keep in mind, however, that as we're seeing this decade-long trend break, we are coming into a region of strong support for the dollar, which exists in the 88.3 to 89.5 zone, as you can see right here in black. Now, this zone goes all the way back here to 2008. Notice these swing peaks right back here in 2008. Notice the swing peak in 2010. This is what got us the beginning of the zone. Notice that once we broke through above this zone in 2014, when the market came back down here in 2017, it bounced at exactly that level going back here to 2008, right? So we're coming back down here to this strong support zone again. And the best estimate is that when markets do this kind of thing, they do not typically just crash beneath a decade-long, even longer, a 13-year-long support zone. They do not just crash below this immediately. And so what we anticipate happening here as we look at these kind of swooping formations here, pay attention to this, a 3-year cycle. Notice this cycle from late 2014, this rise, almost a 2-year rise, 1 year move down. This was a 3-year cycle to the end of 2017. We are just seeing the end of another 3-year cycle here. Okay, so the dollar likes to form these 3-year cycles, at least over the intermediate term. The dollar should be coming a little bit lower. It's at 90.8 right now. It should be coming down to, in this zone, in the 88.3 to 89.5 zone. From there, we should get a bounce. We should start to see a sizable bounce. Now, the mainstream media will not be paying attention to this. They will actually not really be talking about the dollar very much at this point because they're going to be looking at it just, over the last couple of years. They're going to be saying, well, we're seeing a bounce here, so the dollar is just back into the range where it was for the last 3 or 4 years. Nothing here really to talk about. But we, in studying the trends, the long-term trends that the market is making, not just where it is relative to the last couple of years. In studying the breaking of these trends, we will know that this trend, when it's being tested from the other side, that this will constitute a retest of a broken trend. And that the strong expectation after a 10-year trend has been broken is that the market will not recover the former trend. It will not recover it on any bounce. And so the dollar will begin to round over, perhaps into 2022, and then begin to decline once again toward this support zone. And so we'll be looking at this final bounce here. We're going to give this a period of about 3 years maximum to play out, these 3-year cycles. but this should be something of a right translated or right truncated, we call it, basically head and shoulders pattern. You can see here, it's not as clear as some of the patterns that we look at, but it's almost like, you have this head formation here. You're going to have a right shoulder, which is slanted here, and the left shoulder, which is almost the same as the head. Whether we want to call it a head and shoulders pattern, whether we want to call it a triple top, the message here is of a market that is losing its long-term rising trend, and then what? Transitioning to a consolidative pattern. And after a rising trend and then a consolidation, we expect a declining trend to begin in the next several years. That should eventually break this support zone that we are looking at right here. And for that matter, after some backing and filling and perhaps some gyrations, as we saw here in 2011, 2012, and 2013, we should see the dollar approach its all-time lows from 2008 and 2011. This is the expectation for the US dollar versus a basket of currencies when we view the importance of the trend break here, the strong support here, what should be setting up as a failing retest, and then the next logical place for the dollar to come back to the support zone to then finally fail. Now, how are we projecting down here that the dollar will keep falling? This is where we need to back up the analysis and look at, for example, the dollar back since the dollar index began, early 70s, post-Bretton Woods era. Before the early 70s, guys, the dollar was officially tied. I should say other currencies were officially tied to the dollar, so there was no dollar index. There was no way for us to reliably measure the dollar versus other currencies. So we're looking at all the available data here. And just pay attention, we were just looking at this red shaded area in the last slide, but just pay attention to the primary trend breaks that have been witnessed here in the entire history of the dollar index. And look at the significant multi-year declines that tend to result from major multi-year rising trends in the dollar when those are broken. All right, these are not insignificant trend breaks when they occur. Furthermore, remember the old technical adage, we talk about this from time to time, the steeper the trend, the less significant the break. And so the converse of that is the less steep the trend break, the more significant that is. And notice that these trends have been getting less and less steep the entire time. It's almost like every advance that the dollar has here over the last 50 years has gotten weaker and weaker. And so when you break an even weaker trend, it's even more important when this happens. And we're seeing that right now. Okay, so when we have something like this that happens only 3 times in the history of record keeping here, we had better pay attention to this. Let's look for some confirmation in some of the cross pairs that we have been studying here. Primarily, we will look at the euro versus US dollar, which you can see right here in the upper left, euro USD. And then we'll also briefly look at the British pound versus the US dollar. I want to focus on the euro because, as we've said here, the euro does represent over 55% of that dollar index. And so we should place a lot of emphasis on the euro USD cross pair. Guys, we were talking about this over the last several months. I was saying, remember this. The euro had broken that major long-term downtrend. It had broken that going all the way back here from 2008, 2009, this peak. It had broken that trend just a few months ago, and we were in the retest period. Where was the retest? Boom, right there. These little, if you just look here right where my mouse was, this is a picture perfect. Sometimes it's just so beautiful. If you're like me and you like to study how markets behave and how we can plot that out in these charts, and of course, remember, we're simply talking about buyers and sellers, individuals, human beings, banks, hedge funds, sovereign wealth funds, central banks.
We're talking about what all these institutions are doing, but we're looking at the net sum of them right here. And we're looking at the trend had changed. And we saw the change of that trend. And then look at the retest right there. I just love it. And now we are accelerating once again in a new direction for the euro, which implies what? Dollar weakness. So let's plot out what is going to be happening here now that we're seeing confirming evidence of that trend break that we saw 3 months ago. What should be happening here with the euro is a continuation advance to this 125, 126 level. This black line here that you can see representing the swing peak back here from 2018, and also the 38.2% Fibonacci retracement of the entire 2008 to 2017 decline. That retracement matching perfectly with that resistance right there shown in black. So this will be an important resistance zone, and I do not think that the dollar, the euro, I do not think it's going to break through this immediately. I think it's actually going to back off, and perhaps even back off for a period of 1 to 3 years. And again, this will coincide with that bounce that we expect to happen on the dollar index when we said when it gets down into that 88.3 to 89.5 region. Okay, and so the mainstream media will not be paying attention to this. They'll just be saying, whatever, dollar is, euro at 117 or 118 is almost the same as where it was back in 2015. Maybe it even comes back down here to 115 on this relationship here, and so people are saying, see, nothing to talk about. And then we should get it rounding up again, and you should strongly break this 125 resistance zone here. And the next stop, perhaps a brief pause here at the 50% Fibonacci retracement, but I really don't think there's very much to write home about there. There's certainly no swing levels to look at going back into the previous decade. So the next swing peak is up here at 140, which also matches the 61.8% Fibonacci retracement. So that'll be where the next major resistance level comes in. We're already talking about most likely into 2023 or 2024. Now, is it only, and we'll look at this big picture. I want to get back to that idea of the dollar losing its status as the world's reserve currency, and we will see this here on the charts. But let's just look at one other possibility here. Let's look at that Great British Pound versus US dollar. And again, looking at the peak here from late 2007, early 2008, this multi-decade, what is this? The declining wedge that we've been talking about. We were looking at this data point right here, guys, just a couple months ago. We were talking about how I didn't think it was going to break quite yet. Maybe it needed a little bit more time. We're seeing it right now. It's no coincidence that this wedge here is breaking in favor of the British pound at the same time as the euro is accelerating away from the dollar, as we just looked at. So what should be shaping up here for British pound to US dollar is a bit of a continuation advance here up to the 145 region, followed by that 1 to 3 year back off, similar to what we're expecting in the euro, just a different price level. Again, it should lull the public to sleep, and especially the mainstream media, who only focuses on the last 2 or 3 weeks worth of price action. But we will be looking at a very important trend change here in the pound versus the dollar. I will tell you, as someone who likes to travel a lot myself, and in fact, I really want to be doing some traveling in Great Britain and in Europe over the next couple of years, I personally am going to be looking at my window here to do that. I think this could come together well, sort of late 2021 into 2022, perhaps into early 2023. Perhaps the coronavirus calms down by then, and that's what gives the dollar a resurgence. And so perhaps we are all able to travel again, and perhaps we don't need to wear masks everywhere that we go, and we can actually enjoy interacting with fellow human beings as we are designed to do. Perhaps all these things come together, and as U.S. citizens, we kind of have another 1 to 3 year window here to get good value for our dollars when we go to either the British Isles or to mainland Europe. And so that's what I'm thinking. I would tell you that if you're in the same boat with me, or maybe you're retired, or you're thinking about retiring, or maybe you're an independent type of traveler, the message of the markets here is that the window for you to get good value as far as being overseas for your dollars in some of the more developed countries is within the next 1 to 3 years. I think after that, things start to deteriorate for the dollar into the middle part of this decade. And it'll certainly be possible, especially if you derive your income from sources outside of US dollars, if you're protected from inflation with your investments. It will certainly be possible to continue traveling outside the US and to be able to afford it well beyond the middle of the decade. But for those whose incomes are entirely in US dollars and they have no inflation protection, it will get increasingly difficult to do that as these charts start to move upward in favor of the crosspair that is not the US dollar. So let's go back to the euro here, which is just so clear what is happening right now as we're seeing the acceleration. And what I want to do is to talk about the significance of this break from the long-term perspective. So to do that, we are zooming out here to what? This is 1975 to 2055. This is an 80-year chart that we're looking at, guys. Pretty significant, wouldn't you say? And we were just looking at this box right here, this last primary downtrend break that we have witnessed. We've been looking at this long-term chart here once every several months, and the evidence is increasingly in our favor that this model is going to work out. You know, we've been following this model. If you've been with this service, and I know I've spoken with a lot of you guys who have been with us since 2016, and I really appreciate you being here, especially through a lot of the trials and tribulations that we had in some of these models in the last couple of years. But it's increasingly looking like this expectation that we started to formulate here back in 2016 of this being sort of the most recent one of these downtrends in the euro, yet amidst an overall longer term rising trend here. It looks like we're getting increasing evidence that this is in fact playing out. And so here is the most recent downtrend break that we're looking at. Let's look at how some of these patterns are shaping up here from that super long-term perspective. Once again, remember that before 2002, this chart refers to the Deutschmark as its constituent for the euro. It's a proxy, largest component of the European Union as far as economy goes, and so this gives us a fairly reliable representation of what the euro would have looked like before the year 2002 when it was widely circulating. And so we're looking at for example, the first significant decline here in the in the euro. This here from right here in 1981 through 1985, this being a 5-year decline in the euro, followed by what? An 8-year recovery, right back to where it was 1980, 1981. So an 8-year recovery, bringing us into the year 1992, into early 1993. Then what? An 8-year decline into 2000, early 2001. But notice that the low was higher than the previous low here from 1985. 8 years, followed by what? Another 8-year cycle, back up to nominally exceed these peaks here, but really struggling to hold above the 145 level with any meaning. But another 8-year cycle, bringing us into what? 2008, followed by what have we just seen? Once again, another 8-year cycle into the lows in 2016. So except for this, this first decline here, which looks like it was more of the initial reaction. Remember, we're looking at all of the available data here. So it looks like this first impulsive kind of wave down happened a bit quicker, but then we've seen these very reliable 8-year cycles here in the US dollar and, of course, in the euro. And where are we now? We are 4 years after the low from 2016. 4 years. And so if we are going to have another 8-year cycle now, we've seen the downtrend break. If we're going to have another 8-year cycle, what it would mean is that sometime around the year 2024, perhaps early 2025, we should see the euro back approaching this $1.45 level. Okay, now this is not all that much in the grand scheme of things. I mean, we're already at 121 right now, so it's only 26 cents for it to get back up here to 145. Certainly this type of thing has happened before. Certainly this is possible again. It's just most people, most financial outlets are only looking at the last few years here and saying really nothing to talk about as far as the dollar or the euro. We think differently here in this service. We think the euro is about to, with the understanding that there could be that 1 to 2, perhaps 3-year, final dip here. The bigger picture is that we are in another 8-year cycle here that should take us back to the upper regions, this resistance zone shown in black at 145. Why do these 8-year cycles happen, by the way? It's kind of interesting. We spent a lot of time plotting them out here, but this has to do a lot with the presidential and election cycles here in the U.S. and elsewhere, and the ebb and flow of deficit spending, and at least the attempt to perhaps try to rein in the deficit spending in the United States over the last 50 years. Typically, and it's not about one party being better than the other party. I mean, we all know, for the most part, both of the parties are kind of two horses running down the same track in the same direction. Yeah, and they might make little movements in different directions from time to time, of course. But generally speaking, they're both doing the same thing. And so, when you have one president who says, I'm going to get the budget under control, and that requires austerity, and that requires perhaps, fewer social spending programs, or fewer wars overseas, or fewer bailouts for corporations. Fine, we do that for 4 or 8 years, let's say, and then what happens? People get tired of the austerity and they vote in the next politician who promises them more goodies from the public treasury. And so then you have a cycle in which the dollar loses value for approximately 8 years, where the spending is ramped up, where we can't afford it, where we have to borrow our way or print our way out of it, and the dollar starts to lose value again. So you have these quasi-reliable 8-year cycles here. And it looks like we are halfway through the last of those cycles. The last of those cycles that should take us back to what'll be 1, 2, 3, the fourth major attempt here to break and hold above the 145 level. And I will let you know that we do not expect it to once again break higher immediately. So let's say this takes us to 2024, early 2025. We do not think it's going to break higher immediately because we are in what? A 75-year ascending triangle pattern between black and magenta. 75-year pattern, basically starting here from the early 70s all the way through 2055 is the boundary of this pattern. And I have shown you guys in the past that these ascending triangle patterns, they do not tend to resolve, excuse me, they do not tend to resolve until somewhere approximately 2/3 to 3/4 of the way through their timelines. And so if we were to calculate that out, that would be somewhere in the 2030 to 2036 time frame in which we would expect the dollar to finally break out. And so, let us assume that whether it's a little earlier than we are projecting here, perhaps the late 2020s, whether we are accurate and it's going to be 2030 to 2036, or whether it's more like approaching the 2040s. Let us just get down to the brass tacks, which is that the pattern here, the breakout here, which is what an ascending triangle tells us. An ascending triangle is a bullish pattern as these lows are coming up every 15 to 20 years and the highs are staying relatively flat. This is a very reliable pattern that argues that the dollar is going to lose its reserve currency status in a time frame in which it finally breaks above a 50 to 75 year resistance zone that has acted as support for the dollar or resistance for the euro going all the way back to the late 1970s. You will not have a pattern like this that breaks higher after 50 or 75 years, that breaks higher. You will not have that happen in a vacuum. There will be something that happens that causes this pattern to break higher in this kind of way. And the only thing that makes sense from any logical kind of level is that what is going to happen is that there are going to be increasing rumblings around the world as, let's say, China begins to diversify out of its US dollar holdings and Japan begins to sell its US bond holdings. And let's say some of these cryptocurrencies continue to gain in popularity and people move into gold and silver and the historic stores of wealth, right? That there is going to be increasing calls for the world to stop using the US dollar as its reserve as this pattern comes to fruition. So this is the big picture. This is the huge critical analysis that we are now seeing increased evidence for. Remember here, we're not just making these ideas up out of nowhere. We're talking about very clear rising pattern that we're looking at here that has just shown its most recent downtrend break. And so the idea of the dollar potentially losing a lot of value versus other currencies, versus tangible things, versus precious metals, versus cryptocurrencies, perhaps even if they don't get hacked or something like that. But the idea of the dollar losing a lot of value versus basically almost everything is something that should really take a whole lot of your attention right now. And you should actually really sit with this idea. This is not an idea to panic about now or this month, but this is an idea to really think about a lot over the next, let's say, over the holidays into the beginning of next year, and to try to think for where you are as an individual, as a person, with your family, with the way you like to live, with your business. How could this impact you over the next 15 to 20 years when this begins to come to fruition? And we're seeing the initial bubbling of the thesis now in the charts. But how is this going to impact you? It is going to impact each and every one of us. The lessons from history are that individuals can even come out better off than they were before a major currency devaluation if they prepare properly. You can come out better. Your net worth can actually be enhanced. You can actually do things for your friends and loved ones that you were not able to do otherwise. Life does carry on. We're not talking about Armageddon. This doesn't have to be World War IV or III or, this doesn't have to be the apocalypse. But this is going to be something that causes a transfer of wealth, and a major transfer of wealth from dollar holders to those who are not holding dollars and who are diversifying their assets in prudent ways over the course of the next several years. Think about this for yourself. I'll be here to help you along the way as to ideas. There are going to be some more ideas that we get into, perhaps even beyond the precious metals, over the next couple of years, because I think there are going to be ways to protect and to profit in other asset classes as well. So let's get caught up to speed on where we were in the global asset comparison. So guys, this was a small portion of the type of analysis that premium subscribers receive every single week.
We cover not only what we've looked at in this video, but also the physical gold market, the physical silver market, the US dollar, the US stock market, and the rest of the commodities, because everything is related. We also cover the gold and silver mining sector and the exact gold miners that we are investing in here, along with all of the research reports to back that up. This all goes out to you in one service called Precious Metals Intelligence. I cannot fathom being a precious metals, whether you're talking physical gold or silver, or a gold and silver mining investor. I cannot fathom doing that without this information at your fingertips. It is that important. Make sure to check that out on the link to our homepage. If you would like to speak to me, Christopher Aaron, one-on-one, please know that I do individual voice and email consultations with individuals such as yourself. When your situation requires a researched and independent standpoint, know you can come to me. I take no funds, no fees from any of the companies, any of the ETFs that we profile in this service. I simply work for the best interests of individuals such as yourself. There are not too many other fully independent analysts in this space who are not taking kickbacks from someone else. So please be very, very careful who you do business with. We sit down, we talk either on the phone or on Skype, and we iron out a rock-solid strategy for you to go forward from an independent standpoint. Make sure to hit the big red subscribe button before you go any further so you'll be notified when these free videos come out. And last but absolutely not least, I want to thank those people who are supporting this channel on Patreon with donations. It means so much to me. Thank you for that. Guys, I will see you this time next week. Have an excellent week. Stay healthy. As always, see you then.